Let's touch back on the sell-off that we saw in the last hour of trading yesterday. Came after the Fed minutes. The message was higher for longer, same thing that Fed officials have been telling us for quite some time. Are you surprised at the sell-off yesterday? Do you think it continues into today?
Well, Frank, we're not surprised by the market selling off. We came into August, as you mentioned, thinking that the market was going to consolidate, chop around, and probably correct in time and price. We all know we're in a seasonally weak period, and that's after a big move up in the first half. Now, I think with precedent against the market right now, it's going to cap the upside. It's all about yields right now. As you mentioned earlier in the show, the 10-year now is broaching above the highs from last year. So that's going to just cap any upside that we see in the market.
All right, so you don't see a lot of upside. You're saying that yield's what it's all about. So with that in mind, what is your WEX word of the day?
Okay, Frank, the word of the day is a nod back to Guns N' Roses, a song from about 35 years ago, which is patience. And we think that right now investors are going to need a little bit of patience. We had that big run up that I mentioned. And when you look at the seasonal trends, August, September tends to be choppier markets before some better action into the year end. And I think it's normal. It's typically 2 steps forward, 1 step back. But we need a little bit of patience near term to get through this choppy season that we're in.
Guns N' Roses reference. That's interesting. When you said patience and you were doing a musical one, I thought it might be a different band, but that's very interesting. I didn't know you were a hard rock guy. So if we require patience right now and you think that we're also seeing consolidation, there has to be some sector that really benefits, possibly this week with the yield hitting a 15-year high. What sector would you advise your clients to at least look at to put money into specifically today?
Well, we would use these pullbacks that we're seeing to increase industrials, which is our longer-term positive sector that we think has a lot of secular tailwinds. When we think about defense spending going up, we think about a lot of these stimulus bills that are still working away as far as the infrastructure bill, the IRA bill, and so forth. So we think there's some secular tailwinds. So along with the overall market, we would expect industrials to continue to kind of come in somewhat. But for longer-term investors, we think that's an opportunity. And Frank, maybe something else to mention, it's not just what you own. As rates are moving higher, it's probably also what you should be somewhat wary of. And one thing that we're still underweight, that we're more negative about, which is affected by these higher rates, is the real estate market.
Really? You're hitting on 2 things we talked about earlier in the show, Keith. It's like you've been watching the whole hour. What is it about the real estate market that has you concerned with rates going higher? And when you say concern, does that mean you'd be a seller today if possible?
Yeah, well, Frank, I always watch your show. But yeah, we've been underweight in real estate for most of this year. Obviously, as there's kind of this refinancing on debt, those yields are going to put downward pressure. So we saw the real estate market in the market start to stabilize the last few months. These higher rates, I think, will put renewed pressure on that area. And then outside of real estate, if you think about it, you've also seen the U.S. dollar move up. I think another headline you had today is China. We've been negative on emerging markets for some time. We basically went to zero allocation in our global asset allocation last year. And we still think that's going to be under continued pressure. And we would use any rallies in those markets to stay underweight.
All right, so Keith, you're talking a lot about equities, but before you're saying it's all about yields. We're looking at the 2-year as well. Yield almost at 5%. So is this changing your thought about when it comes to fixed income strategy? Would you advise clients to put more money into fixed income right now to really take advantage of that higher yield on the shorter end of the curve?
Yeah, we like a barbell strategy, meaning we like that short end of the curve where you're getting 5%. And, there's a lot of momentum in that 10-year breaking above this high, so you don't want to be too aggressive. But as yields continue to move up, we do think that there's some value in longer-term bonds, say, out to about 10 years, because even if yields continue to go up, because of that coupon that you're getting, right, that income coming in, it will offset any price losses up to about 475, 480 on the 10-year.
All right, one more thing to ask you about very quickly. Walmart reports coming up after the bell. Generally seen as a bellwether of retail. How do you think this is going to instruct how you tell your clients to invest in retail going forward, this print?
Yeah, listen, I think, retail, Walmart does do a decent amount of selling to, for essential goods. So I think overall that they'll probably have the story will be fine about what they're seeing in trends. It's not going to really change our view per se, but I will say the discretionary sector is something that we're overweight, not just because of, some of the underperformance in retail, but they also have a lot of these big growth names in there as well. So we think that overall sector does fine.